Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Well, we've got a couple of things we will talk about today, mainly around price action. We've done quite a few deep dives into various aspects of macro and world markets lately, and we will continue doing those. But today, I'd mostly like to focus on price action. We haven't devoted very much time to that recently, and I thought it'd be good to just kind of look at the charts together, talk about some of the things that we're seeing. I'm not sure that we'll pull out some magical insights, but it'd be good to level set on what we're seeing happening in equities, in crypto, in commodities, and try to marry together what all these forces are doing. So don't go anywhere. If you enjoy this content, please give my video a thumbs up and subscribe to the channel. Your support means everything to me, and I can't thank you guys enough. Now, let's talk about the markets. Well, here we are on the morning of Wednesday, October 26th, and there's a bit of a mixed outcome here a few minutes into the open. The markets opened about 15 minutes ago, and the indices are going in different directions. So the S&P is currently down about 0.5 percentage point, 0.75 percentage point. The Dow Jones is closer to break even, but the NASDAQ is down a whole 2 percentage points. And a big reason for that is because big tech got utterly vaporized in after-hours trading yesterday. Here's Microsoft, and we can see that they opened down here. They're currently down about 7% after yesterday just getting rinsed in after hours due to an earnings miss. They also gave kind of a crappy outlook, and those factors combined saw it selling off. Likewise, Google had a similar type of earnings miss, particularly with YouTube revenue. It was expected to be positive, and they missed negative. And we can see they also gapped down here. They're currently down about 7.5%. Both of those are members of the NASDAQ, and due to their market cap, they have a considerable weighting in it. So the two of them combined are kind of pulling down the NASDAQ today from its high from yesterday. It's currently down about 2%. But we know from recent price action, well, the way that it opened is not necessarily the way that it's going to close. But right now, as I'm recording this, there's a big disparity between the indices, about a 2% distance between the NASDAQ and the Dow. So we've got a divergence there. And what I'd like to kind of explore here is the viability of this pump. Maybe if we think that it's continuing to have legs, or if maybe it's starting to stall out. And that's really difficult to determine in these current conditions because outside macro factors can arrive seemingly without any warning at all and throw a wrench in any kind of rational TA you're trying to perform. So I say all of this knowing full well that what we talk about could be invalidated within a day or two, but that won't stop us from at least talking about what we think is going on. And as I look here on the S&P, it's up about 9.5%, close to 10% off these lows here from October 13th. And they're coming up on this relative composite resistance here. So we had this multi-week range that took place right in here. And if we look at the high closes from this period, we are creeping up towards that area. Now on the daily RSI, it doesn't look like it's fully topped out, but if I start going down to some of these lower time frames, 8 hours, 4 hours, 2 hours, it looks a little bit toppy. It looks like maybe it's coming up to the end of this particular leg and seeing this resistance here. It's not out of the question that sometime over the next few days, maybe we see a little bit of chop here. Now, if we get up and we start to accept above this, then I would think maybe we'd have room to go a bit higher, probably up to this range up here around 4,200, 4,150, because that's just kind of the next level up. So maybe that's the next spot we go to after a little bit of consolidation. We've got confluence here between the S&P and crypto. If we go over and we hop and we look at Bitcoin, it doesn't quite look the same as what the S&P has been doing, and it hasn't reached a second lower wick the same way that the S&P did. If we look at the S&P here, it hit a recent lower low in October, and the Bitcoin chart hasn't done that since June. It's just been hovering sideways like a land speeder, and it has now crept up to its own kind of little area of resistance. I thought maybe it could get up to the midpoint of this range, but it didn't. It actually went to about right here. And if you look at the RSI for Bitcoin. This is on the daily. It looks a little toppy. As we start going down to lower time frames, it starts looking really overbought. So I think that when you see this confluence here with Bitcoin, similarly with Ethereum, I've drawn some diagonals on here. I don't really put a ton of weight in diagonals, but just if we're going with RSI confluence here, look on the daily for Ethereum, it's in overbought territory. So when we see Bitcoin, Ethereum, and the S&P all kind of approaching overboughtness, a little bit less so on the S&P, and it's happening as the S&P is nearing this middle of the range resistance area, I think it makes sense that the momentum starts to slow down a little bit. But that doesn't mean that that's necessarily the end of the pump. The S&P is really choppy, and it has been reliably traversing its ranges. So I do think that it's possible that this pump could make its way up to above 4,000 again, but we really need to see how it reacts to this 3,900 level that remarked a point of resistance in the previous pump. Now, if we look at the DXY, this is one of the reasons why the markets have been able to pump lately. The DXY is the denominator of all assets that we look at in the market, right? Everything is denominated in dollars. So when the dollar is strengthening, it makes sense that markets, which use dollars to price things, are thus weakening. But if you put a parabolic curve here on the breakout of DXY going back to, early 2021, you can see it's been respecting it really solidly, and we have now finally broken out of this parabola. You can see a change in momentum. Now, I don't know if that means that DXY has properly topped for this particular cycle and that it's going to do one of these down here. There's still a lot going on in the macro picture. And when you think about the dollar-yen market and what a shit show this has been, it's hard for me to confidently state that DXY won't see another leg higher. But at least for now, it's starting to break down, and that provides a headwind for equities. It's a similar story if you look at the yields on US Treasuries. Many of them are starting to, what it looks like, try to top. Now, yields have tried to top before. We saw that back here in June and July. We know how that played out. So I'm not going to get in front of a moving train and call top on bond yields. But it is clear that they have curled around the same time that we've seen a break in parabolic structure on the DXY. So that makes sense that we're seeing lift in risk assets. Similarly, something that helped the pump was the breakdown in oil. So you can see here in early October, oil retested the invasion price from when Russia entered Ukraine, back tested it, and broke down further. Now it is starting to curl a little higher here in the last couple weeks, but this move down in oil is what helped to support in part what happened with risk assets. Because everyone's watching the price of oil, everyone's watching the cost of energy. So the breakdown in oil did help, but it is curling a little higher here. We know that there isn't any relief coming on the supply side for oil prices. So that's going to continue to complicate the ability of oil to break down significantly into lower prices. So right now it's a little bit range bound between the invasion price and this yearly level that goes back to 2021, really all the way back here to 2018. So I am watching what's going on with oil. And curiously, as oil has curled a little bit, we've seen gasoline prices very quietly climbing back from their September lows. Currently, gasoline prices are about, I think, 30% off the lows. Yeah, just about 30%. And they're back testing this $3 breakdown area that goes all the way back to earlier this year. And maybe what this market needs is for old Uncle Joe to come out like he did in July and tell gasoline owners it's their job to lower prices. He's certainly going to claim credit for this breakdown, so maybe he should claim credit for starting another leg lower in gas prices. Maybe we'll hear that sometime in the next week or two before the final polls for midterm elections come through. I'm just joking about Biden. What I really wanted to point out is that gasoline prices have been rising. They're currently back testing a support area that they broke down from earlier this year. And I would expect that if this is the trend, if the primary trend is to continue down, that a place like this could offer a reversal point. But if not, if gasoline breaks higher, then we're going to see panic in Washington, and that probably would provide a headwind factor on risk assets. Now here on the S&P, there's one thing I'd like to dig into a little more finely, and it's this big candle right here from October 13th. Now it showed only a 2.6% gain on the day, but the body of the candle from wick to wick was gigantic. And I'd like to talk about how these candles occur in the context in which they occur. So what we're looking at here is the S&P 500 going back to 1962, and it's showing the relative intraday swing of the index. So based on the previous day's close, it looks at the lowest percentage position on the day and the highest percentage position, takes that as a total range and prints a bar on this chart. And there are a couple of observations that I'd like to make about this chart. The first one relates to this candle we just talked about on October 13th, just from a couple of weeks ago. That particular day was a 5.4% total range. Now, I said the candle was only a plus 2.6% from the previous day's close to that day's close, right? That's 2.6. But the entire range from the worst position to the best position was 5.5%, 5.4%. That seems like a big number, and it is, particularly for the S&P historically. That puts it as one of the most volatile days in the history of the index, counting over 15,000 market days going back to 1962. In fact, it is the 63rd most volatile day in the history of the index, out of, like I said, 15,000 plus days. And you can see there are a few other instances of this occurring. Up here, I've got the top 10 and the October 13th day shown as number 63, so you can get an idea of what a big day looks like. And there's a couple of things that I've observed about this chart. The first one is October's a really bad month. I mean, look how many of the top 10, looks like 8 of the top 10 occurred in an October of some year. Most of them occurred in October 2008 and October 1987. Those were two of the most disastrous market crashes in the history of the S&P. If we go back and look at the S&P, this was October of 2008. Utterly brutal. If I go back a little bit further, we go back into the 80s. This was October 1987. I don't even have to circle the area for you. You can see it. It occurred over like a single week period, really like 3 days were where most of it happened. And this was the flash crash of 1987. These two events created the top 10, with the exception of one day in 1962. They created the top 10 most volatile days in the history of the index. If we go and we expand this list and we look at the top 30, you can see that the majority of them came in the final quarter of 2008 as the great financial crisis reached its apex. Most of these intraday swings are 8, 9, 10%. Huge moves. And when you think about how this most recent candle over here was 5.4%, and many of the top movers are 7, 8, 9, 10%, almost double what we saw on October 13th, it gives you an idea of how volatile these moves can be, and they mostly come in bear markets. I encourage you, pause my video, look at each of these dates on the S&P's price chart. Go and look them up in TradingView or wherever you look at the markets, and look at each of these dates. The vast majority of these major intraday swings occurred as the market was cratering in a deep bear market, most of them. And that's part of the tricky aspect of managing your emotions and your exposure to the market during a bear, because volatility expands, the liquidity and the density of the order book thins out, and so there's less friction on price moving in either direction. And also, emotion is very fragile, and so when you see a move of a couple percentage points, it can lure in some of those lower information participants. They get suckered in thinking that they're going to miss the move, and they start FOMOing into what ends up being a relatively thin bear market rally, and often price reverses on those people within a day or two. So in terms of scale, what happened a couple of weeks ago is one of the biggest days in the history of the index. It's the biggest day in terms of relative range since the crash in March of 2020, and it's the 63rd most volatile day in the history of the index, at least as far as I can get intraday data for, back to 1962. So I exercise caution when I see these big kind of moves. I understand that they can happen, and they don't necessarily mean that the market is reversing. I mean, if you were buying here on October 9th of 2008 thinking that this 9.8% intraday swing was marking the low, you got wrecked literally the next day when it opened red and then bounced another 10% again. And then 3 days later, it did it again. A week later, it did it again, even larger. So these kinds of choppy moves are the normal way that the market operates in a bear. That's just the way it goes. Each of these moves here is is gigantic and they catch people off guard, right? I mean, look at this open. Look, the market went down 7.5% on October 9th. It opened lower, shot all the way up halfway through the candle from the day before, fell all the way down below it, almost the same distance, and then closed relatively flat. This candle right here destroyed some people's net worths. This one day right here. And you got a bunch of them in a row, as you can see by my chart right here, by my list. So this kind of volatility is normal. It's to be expected, and you need to be able to manage your way through it if you're going to survive the bear. So maybe the DXY is broken down a little bit. We're going to be patient. We're going to let it play out. It's clear that momentum has broken a little bit, and it was inevitable that this would happen. When you draw a parabolic line on a price chart, it's not realistic that it's just going to continue to follow this forever. At some point, it's going to break down, and it's breaking down now. That doesn't mean that this is a full change of direction. It just means that the parabolic rise has had to pause because it reached a breaking point in momentum. And that is lifting risk assets. But as we pointed out, and you can see on my list over here, the Dow Jones is up 0.3%. The NASDAQ is down 1.6%. And that is in large part because of the big tech sell-off that we talked about. We noted that Bitcoin and Ethereum and the S&P all look overbought on their low time frame RSIs, and the lower you go, the more overbought they look. And considering that the S&P and Bitcoin are both coming up upon kind of a structural resistance area, a place that might provide some friction, I think it makes sense that we see the rally maybe consolidate a little bit here and look for strength, look to gather some strength. So I'm watching to see if we can get to this level and kind of chop around a little bit here and start to accept above it, because that would indicate perhaps we could move up closer to these range highs. Oil broke down from the invasion price, but has started to curl higher. And I have serious concerns about the supply restraints on oil globally. OPEC Plus cut production, and they were already missing their quotas. The Strategic Petroleum Reserve has been draining at a record pace. And U.S. oil producers are not investing in energy capex. They're not building out new drilled and uncompleted wells. They're not preparing new sites for production at the pace necessary to support lower oil prices. And what is likely to need to happen in order to spur that investment is either a change of tone out of Washington completely on their views on petroleum, which is not likely, or higher prices. The cure for higher prices is higher prices, particularly in commodity markets, where high prices encourage new production. They bring production online. So those factors are in the back of my mind when I'm looking at oil here. You know, my friend Blockchain Backer, he's really good with fractals, and he has a belief that oil is breaking down from this point and that it will go lower. He may end up being right about that, but there are some things complicating that effort, and I would be curious to see what kind of market catalysts arrive to drive oil significantly lower from here, considering those supply tensions that I just described. We'll keep an eye on that. We'll keep an eye on these oil prices. And we'll watch to see what happens with this rally over here in Legacy. I still think that we've got an earnings shoe that needs to drop for this market, and I don't think that we just got it. You know, we had Google and Microsoft selling off because of earnings misses, but broadly, equities have not had a bad earnings season, and I think that some of that is still carryover effects of the inflation we've seen and the liquidity and savings that have been sloshing around in the system for much of this year. But as these things continue deteriorating, as we stay with higher rates over the next few months, and as the Fed is likely to continue hiking, according to FedWatch, we're going to get 75 bips on November 2nd, and in December, we're likely to get 50. It did think we were going to get 75. You may recall in our last video, we looked at this chart and it was showing a 75% chance of 75 bips in December. Well, that is now flipped and they think it's 50. So we're going to get some more rate hikes. And over the next couple of quarters, these effects will really start to seep their way into the economy. There's probably like a 12 to 18 month lag on monetary policy actually becoming effective in full in the market. And we're only like 6 to 8 months into this hiking process. We haven't really even seen a full year of these new effects. And I think that much of that will play into what happens next year, in the early part of next year. And I'm waiting to see what happens there. But the Fed is already starting to talk about what the future looks like when they aren't hiking so aggressively. So Mary Daly, the head of the San Francisco Fed, she made some comments last week that provided some dovishness to the markets and helped to encourage the rally that was already ongoing. And many of her comments suggest that the Fed is starting to loosen the market up for the expectation that they won't just hike 75 bips every frickin' time. But it also seems like they're trying to massage sentiment a little bit and not let investors get overly excited about a slowdown in hiking pace, because that is not a reversal. It certainly is not a pivot or the lowering of interest rates. It's just a slower pace of the raising of interest rates. So some of the things that Mary Daly said recently, we are now at the point in policy where we must be thoughtful. We need to do everything in our power not to over tighten. We have another 75 hike, but it's not 75 forever. I want to avoid an unforced downturn by over tightening. We will perform a step down, but not a pause, to 50 or 25 increments. If you continue to tighten until lagging variables of unemployment and inflation return to a steady state, you could easily over tighten. It is important that we slow our rate hikes. So these were some overtly dovish comments, and some of the first of their kind out of any of the Fed governors so far this year. To me, this marks a tonal shift in what the Fed is talking about. Powell himself may continue to be kind of hawkish, but his governors are expressing a more dovish approach. But we've likely still got at least another 150 bips or so of hiking to go, based on what the market is expecting and has priced in, which we talked about in the previous video. Will it be 75-75? Will it be 75, 50, and 25? I think that is probably more likely, with 25 coming in February, and then we take it from there. So let's bring all of this together. We've got the Fed softening up the market to be prepared to slow down the pace of their rate hikes. We see equities pumping. They look a little overbought on lower time frame RSI, and they're approaching kind of a middle range resistance area. Same thing for Bitcoin, similarly for Ethereum, all looking a little overbought. Oil broke down at the same time equities began pumping, and at the same time that DXY broke down out of its parabolic rise that began in 2021. All of these have been supportive of risk assets. They will continue to be supportive of risk assets. But when we know that there's at least 150 bips more hikes to come, and we see yields curling currently, I think that we are a little ahead of our skis if we're calling top on yields. Even though they've started to kind of flatten out here in the middle fours, it's clear that the momentum higher has started to slow. We should watch and see what the central bank does with their direction of monetary policy, their direction of rate policy specifically, before we get excited to call the top in treasuries. But it is coming, and it looks like the Fed is warming us up for a slowdown in hikes to where we would at least reach a plateau of some kind. And that is where we will leave it today. No major insights, no huge alpha hiding in this video. Just wanted to talk through some of the price action, some of the different assets and the ways they've been moving lately. I feel like sometimes we get too caught up in going way deep down the macro rabbit hole. Occasionally, it's good to just look at some price action and keep it top level. So that's where we'll leave things. Make sure you follow me right here on Twitter at TXMC Trades. I also encourage you guys to check out my newsletter. I started it about a month and a half ago. You can find the link in the description to this video or on my pinned tweet on Twitter. This is a place where I share some of my longer form ideas. We do deep dives into history. We look at market structure from the past. I share unique charts that don't always make it onto my streams. I give you interactive versions of these charts, and this is a way for me to try to turn this into a career. I'd love for you to just continue watching my videos, but if you'd be interested in getting some of my writing into your inbox with some access to my bespoke charts, I highly encourage you to check that out. I would love your support. And that's where we'll leave it today, friends. I wanted to make the deliberate choice not to go deep down the macro rabbit hole today. Sometimes I get so caught up in providing unique alpha to you guys that we don't just take a step back and look at top level price action. So that was what my focus was today. We'll see how the rest of the week plays out, and we'll talk again in just a few days. So until the next time that we speak, take care of yourselves, friends. Take care of each other. Go outside, enjoy the changing weather. The mornings are starting starting to get pretty cool here in Texas. I'm excited about it. And we'll chat again in the very near future. So stay positive, keep a good perspective, watch less mainstream media, and you and I will chat again in just a couple days. Cheers, friends.